And we will remain. Okay, are the cameras on? I know the recording has started.
The cameras are on.
Great, thank you, Diane. Okay, good morning, everyone. Welcome to the New York City Retirement Systems Common Investment Meeting for Friday, September 17th, 2021. We will start by calling the roll, and let's start with police. Is Kevin Holler in there? I see the police boardroom and I see that it is on mute. Okay, we'll come back to police. So let's move to fire because I did see Mr. Dunn. Pat?
Good morning.
Good morning, John.
Morning.
For the city of New York,
Does that mean for the
John,
fire?
I saw Schumann was having trouble getting on. I'll, Cynthia Collins designate for Mayor Bill de Blasio.
okay, thank you. For the controller,
By the way,
Jennifer Konovitz for designate for controller Scott Stringer.
okay, for finance,
CPF Finance Commissioner Sheriff Sullivan.
okay, UFA, Mr. Ansbro,
Bobby Eustace with Andy Andros proxy.
okay, Mr. Eustace is present. Mr. Edward Brown,
Bobby Eustace with Eddie Brown's present proxy.
okay, Eric Bischoff,
Eric Bishop present.
Mr. Peter DeVita,
John Young with Peter DeVita's proxy.
okay, for the UFOA, Mr. Christopher Jensen, I got a report just so you know that the UFOA is having technical difficulties. So I'm going to go through them, but they'll probably be joining us momentarily. Mr. Guilfoyle, Mr. Mannix, anyone on board with the UFOA? Okay, and Fire Commissioner Dan Nigro's rep.
Terrell Brown for Commissioner Nigro.
Okay, we do have a quorum, and they'll acknowledge when they join the meeting, the UFOA.
Thank you, Pat. Okay, I see that Kevin Holleran is back, so can we do the roll call at police?
Okay, good morning. Representing the PBA,
Joe Alejandro, good morning, everyone.
DEA, I know we have someone on the way, probably in the building already. SBA,
Kevin Lucharco here, got the proxy for the DEA. I mean, the SBA, I'm sorry, the SBA.
and the LBA. CEA,
CEA Johnny Ramirez for Chris Monahan.
Commissioner of Finance,
CPF Finance Commissioner Sheriff Sullivan.
Mayor,
Cynthia Collins designate for Mayor Bill de Blasio.
Controller,
John Dorsett, designate for Controller Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg, designate for Commissioner Shea.
We have a quorum.
Kevin, I just want to add in, Betty Caradero may be running a little later. I don't know if she just made it on or not. So you want to call her name?
Okay, Betty, are you on?
Hi.
Okay, fair enough.
Okay, so
and-
later on.
Did you get Tom?
And I also, John Adler,
Yes, sir.
I just want to also announce that while I'll miss many of the trustees, this will be our last combined investment meeting, so common investment meeting. So I want to thank everybody for the hard work over the years, and I've gotten to know a few of you, and I appreciate a lot of the efforts on everyone's part. So
Okay, thank you, Joe.
thank you.
Hey, guys, just a heads up, the UFOA is in the room. I apologize. We had some technical difficulties this morning. Liam Guilfoyle is here. I have the proxy for both Chris Jensen and Paul Mannix.
So let's add that to the file.
James Katz on behalf of Manhattan Borough President Gail Brewer.
Okay, hold on a sec, James. Hold on. We're not calling nicers yet. We'll get to you. Okay, so we have the fire, roll. And let me just also say that Shuman Ray joined also for the police pension fund representing the mayor.
Thank you.
Okay, thank you. All right, let's move to NICERS. Ms. Wintery,
Good morning, Chair, Mayor's Office,
John Adler, President.
Controller's Office,
David Jetter, designee for Controller Scott Stringer.
Public Advocate's Office, Borough President Manhattan,
James Katz on behalf of Borough President Brewer.
Borough President Brooklyn,
Good morning, Tanya Cantlow, representing Brooklyn Borough President Eric Adams.
Borough President Bronx,
Good morning, Mirtha Camille Sabia, representing Bronx Borough President Ruben Diaz Jr.
Borough President Queens,
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island, International Brotherhood of Teamsters,
Ruben Torres and Lawrence Bosley for President Gregory Floyd.
Transport Workers Union,
Dave Katzman for TW Local 100 President Tony O'Donnell.
and District Council 37.
Robin Roach on behalf of Executive Director Henry Garrido.
We have a quorum.
Thank you, Melanie. And teachers, Ms. Riley? Patricia, maybe you're on mute.
I think I had it by now. John Adler,
Yeah, I'm here.
Thomas Brown, Natalie Green Giles,
Yes, I'm present.
David Kazansky,
Present.
Russell Buckley,
Present.
Deborah Penny,
Present.
Susanna Vickers.
Morning, I'm here.
We have a quorum.
Thank you. And just coming back to NICERS, is Elizabeth Guzman here? Okay, I got a note that she was, but I think she's having technical difficulties. We'll add her to the roll when she gets here. Mr. Alejandro, I see a hand raised. Is that-
John, we can wait until the rolls are complete or everybody's in. I'm not sure.
The rolls are virtually complete. What would you want to say?
Hold on. John, I also have Jeff Ward is present in the room with me, representing the DEA.
Okay, so Jeff Ward for the DEA. Let's just, okay, hold on for a sec, Joe. For the Board of Education Retirement System, Mr. Rich, are you with us?
Morning, John. We're represented today by Natalie Green Giles, trustee, and Russell Buckley, trustee, and we do not have a quorum. We will administer this business at our next board meeting, which is scheduled for September 23rd.
Great, thanks. Okay, Officer Alejandro.
Thank you, John. In preparation for us leaving the SIM, there was discussions had on many parts. And so one of the things that I guess to give us some basis of understanding going forward was the issue of a request for some audit to be done with regards to spending and practices at the Bureau of Asset Management. So I think going forward, I think a new controller is going to come in. I'm sure the current controller would agree that transparency is a good thing. So I think I'd like to put out for discussion of having a basis of understanding as to the spending and auditing of Bureau of Asset Management. All pension funds get audited, unions get audited, other city agencies get audited. We have spent some money to set up a system under the control at the Bureau of Asset Management. We do get bills. I've just been shown some, but they don't give you a complete understanding of spending practices. They just tell you exactly how much was spent in positions. And I think we need to get a clear understanding what an audit can give us. So I just want to put that out there. I think police is interested in doing that going forward.
So Joe, it's not on the agenda for today. We can add it to the agenda for the next SIM, and perhaps you'd want to join that, but that's up to you. Or you can put it on the agenda for the police investment meeting whenever that takes place. So thank you for the comment, and we're going to move to our agenda, which is quite long today. So we're
John,
going to stick to it.
could I just note that Elizabeth Guzman has joined for the NYSERS Board of Trustees?
Yes, thank you.
Thank you.
May I ask 917-596-7914 to identify themselves?
Yes, that was me, and I'm hanging up now.
Who is me? I'm sorry.
This is Elizabeth Guzman, NYSERS Board of Trustees.
Thank you.
Okay. All right, I think that completes the roll call. Is there anybody else who has arrived since the roll was called for your board? Okay. So with that, let's turn it over to Alex Donier for the quarterly fund performance overview.
Yeah, Andrew Ansbro, you have.
Okay.
Ready, John?
Yes.
Well, thank you, John, and good morning, trustees again. Hope everyone is doing well. Today, we're here to present performance for the quarter and the fiscal year ended June 30th, 2021. But first, I'd like to begin by congratulating all the trustees, Comptroller Scott Stringer and BAM staff for the exceptional results that the pension funds delivered for the fiscal year 2021. It truly is a testament to the collective focus and hard work of the boards, the Comptroller's office, and staff during unprecedented times. I will be presenting Q2 results and fiscal year returns, and then we'll have Dan Haas presenting the risk report for the quarter. Next slide. So first on this page, we have plan assets by system and in the aggregate as of June 30th. As you can see, the system's assets in aggregate stood at approximately $266 billion. Next slide. Now for the second quarter of the calendar year, returns by system range from 5.28% for NYSERS to 5.89% for BRRRR. And for the fiscal year, returns range from an impressive 24.8% for teachers to 27.97% for BRRRR. The systems posted very strong returns in Q2 and the fiscal year period as global equity markets continued to rally. Now in the quarter, the systems, excluding NYSERS, outperformed an index portfolio. NYSERS just slightly underperformed. Now that's primarily driven by the system's exposure to emerging markets, which is not part of the index and generated very strong returns in the quarter, and also strong private market returns. Now, given the strong equity rally, the system significantly exceeded the 7% assumed rate of return in the fiscal year and also in the trailing 3 and 5 year periods. In addition, all systems have outperformed a 65-35 index portfolio over the 5 year trailing period. I would note that the systems, excluding BRRRR, underperformed other large pension plans as measured by TUX in the quarter, as the TUX universe has a larger exposure to private markets, which outperformed the public markets in the reporting period. And again, I'll remind you that TUX reports gross of fees. Next slide, please. So here we have total portfolio performance for each system for the quarter versus each system's custom benchmark. So all systems slightly outperformed their custom benchmark in the quarter, as you can see from the bar chart on the far right-hand side. The horizontal line represents the 7% assumed rate of return for the quarter, and all systems significantly exceeded the assumed rate of return. Next slide. Now, when you break down the components contributing to the slight outperformance for all systems, you'll notice that it's primarily due to manager value add. the systems managers generally performed either in line with their benchmark in public equities and fixed income, with some exceptions, and also outperformed in private equities, OFI, and infrastructure. Now, in the following slides, I will highlight performance by asset class. Next slide. So here we show US equities performance versus the benchmark. Now, while teachers performed in line with his benchmark, the 4 other systems slightly underperformed their respective benchmarks in the quarter. Now, the rotation to value over growth, which started in Q4 of 2020, as you'll recall, reversed trend in Q2, as the Russell 1000 Value Index trailed the Russell 1000 Growth Index by 6.72%. Now, for NYSERS, police, and fire, underperformance was driven by value-oriented managers, such as Research Affiliates, Scientific Beta, Cook & Bieler, and Pzena. For Burrs, underperformance was driven by his mid-cap active manager. Next slide. Here we have the EFI portfolio. For the quarter, all systems outperformed their respective benchmarks. Now, this outperformance was primarily due to the growth-oriented managers in the portfolio. As similar to the US equity portfolio, growth outperformed value in the developed ex-US market. Next slide. Here we show emerging markets. For the quarter, all systems, excluding fire, outperformed their respective benchmarks. Now, unlike developed markets, value outperformed growth in emerging markets for Q2. Fire's underperformance was driven by Pzena, although I would note that that manager has performed strongly in the trailing 1-year period. Next slide. Now, moving on to the fixed income portfolio. Overall returns in the quarter slightly outperformed the benchmark for all systems. Now, the fixed income markets were positive in the quarter, with the Barclays Agg up 1.8%. I would highlight investment grade credit, which did well in the quarter as treasury yields were lower, with the 10-year treasury down 27 basis points at 1.47%, and IG credit spreads were tighter by 9 basis points. Next slide. Turning to high yield, all systems generally performed in line with the benchmark, with opportunistic managers leading the way. Now, in the quarter, CCC rated bonds outperformed, and oil and gas, midstream, and the real estate sectors led performance. The index returned about 2.74% in the quarter. Next slide. Here we have hedge funds for police and fire. The hedge fund portfolio performed in line with its benchmark in Q2 and underperformed for the fiscal year-to-date period as equity markets continue to rally. However, over the 3-year trailing period, the portfolio continues to outperform its benchmark. Next slide. Now let's turn to private markets, and one more slide. So we'll begin with the OFI portfolio through Q2. While OFI is trailing the benchmark since inception, which is the public market equivalent or PME, plus a 300 basis points illiquidity premium, in aggregate, the OFI portfolio has returned since inception 8.2%, and that compares to 6.4% for the PME. Specifically in Q2, the OFI portfolio had an estimated net return of 4.6%, significantly outperforming the custom blended PME benchmark, which returned 2.1% during the quarter. Now, for the fiscal year, the portfolio returned a very strong 22% versus 14% for the PME benchmark. As in the prior quarter, gains in the portfolio in Q2 were driven by managers with broad credit mandates, where managers were able to be flexible and opportunistic, and they were able to take advantage of market trends that favored distress, riskier segments, and COVID-impacted sectors. Let's move to private equity. For PE, we have performance through Q1, as performance is reported on a lag. Q1 2021 since inception returns for the systems range from 11% for NYSERS to 14.4% for Burrs. As we show on this chart, teachers, police, fire, and Burrs outperformed the public market equivalent since inception, which is a Russell 3000, while NYSERS slightly lagged. and all systems continue to lag the PME benchmark, which is a Russell 3000 plus a 300 basis points illiquidity premium. Now, the overall portfolio improved about 45 basis points in absolute returns in Q1 versus the fourth quarter of 2020. Now, while the PME increased by only 27 basis points. So as a result, the system's PME spread increased 18 basis points on average from Q4 to the first quarter of 2021. I would note that the PE portfolio's valuation continues to recover strongly. After being down about 9.5% in Q1 of 2020, the PE portfolio in aggregate is up 9.8% in the second quarter. Then it was up another 10.3% in the third quarter of 2020, and then up another 11.8% in the fourth quarter of 2020. And in the first quarter of this year, of 2021, the portfolio is up another 9.3%. So very strong returns since Q1 of 2020. Next slide, please. Here we have core real estate. So looking at first quarter of 2021 since inception performance, core real estate investments are underperforming the PME benchmark for all systems. Core real estate actually rebounded in Q1, and this is for the second consecutive quarter, as fund managers continue to regain confidence given positive COVID trends. However, the portfolio did underperform versus the PME in the quarter as the market outperformed the increase in the core portfolio's valuation. Next slide. Here we have non-core real estate. So again, looking at Q1 since inception performance, teachers, NYCERS, police and BRRRR's non-core investments they're outperforming the PME, while FIRE slightly trails. In addition, the non-core portfolio was marked up by 15 basis points in the quarter versus Q4. And this for the non-core real estate portfolio would be the third consecutive quarterly valuation markup since the beginning of the COVID-driven valuation markdowns. I would note that FIRE's relative underperformance since inception is due to meaningful exposure to underperforming pre-GFC investments. And lastly, turning to infrastructure. So for Q1, performance continues to be strong with since inception returns of 12% net across all systems. And all systems have outperformed both the PME benchmark and the IPS benchmark, which is the CPI plus 400 basis points. I would note that renewables, transportation continue to be the largest sector exposures at 21 and 20% respectively. And North America and Europe are the two largest geographic exposures at 48% and 34% respectively. So with that, that concludes remarks on a very strong quarter and fiscal year 2021.
Sorry. Let's see if there's questions for Alex. If you have a question, please use the raise hand button in your reactions tab in Zoom. I'm going to ask a question while we're waiting to see if anybody else has a question. Alex, you went through the quarter report with the benchmarks. In other words, the total portfolio basis points of excess return over the portfolio, but you didn't do that for the annual. So we had these great absolute returns, ranging from roughly 25% to roughly 28%. How did our policy benchmark, how did we do versus the policy benchmarks at each fund? Do you have that information?
I do. Hold on one second.
John, this is Patricia Riley. I just wanted to mention that Thomas Brown was here. He just couldn't get off mute.
Okay, great. So if the stenographer can make a note for the record that Thomas Brown is present for teachers as well. Thank you. If anybody else has questions for Alex, if you would hit the raise hand button, and otherwise Alex can answer my question, and then we can move along.
John, my hand's up. I just wanted to, I have some questions that I think would be more appropriate for executive session. So I just want to put that out there now so that way we could address that at the appropriate time.
Great. Okay, we'll do that in exec. Thanks, Dave. And remind me if I'm making a note, but if I forget. Okay. And sorry, your hand is a little difficult to view with it's up in the window there. Is a little difficult to see in the background, but that's my fault, not yours.
So John, to answer your question, 4 of the 5 systems outperformed for the total fiscal year in aggregate versus their respective benchmarks. You have police slightly trailing, and that will range anywhere from, let's see here, you have fire, 5 basis points over their benchmark. You have BERS 50 basis points over their benchmark, NICERS 29% over their benchmark, teachers 77%, 77 basis points over their benchmark, and police 60 basis points trailing their benchmark in the fiscal year.
Great, thank you so much. I guess I would appreciate it if you could, in the presentation, put that information as well beyond the quarter, but maybe for the trailing.
Sure.
As well, I think that'd be useful. Thank you. Okay, any other questions for Alex before we move on to the next agenda item? Okay, so you want to move on to the risk report?
The risk report for Q2.
Okay. Well, thanks, Alex and John, and good morning, everyone. As in the past, of course, we'll spend a few minutes today just highlighting some takeaways from the quarterly risk reports that you'll find and convene. Can we move to the next slide, please, Diane? Thanks. So here, as before, of course, is an example of the risk summary that appears on the quarterly reports. If we were to look at the top left panel, you'll note that the total plan risk for the quarter ended June 30th was 12.77%, down from 14.24% in March. There's an important note here. We migrated to a new factor model at MSCI beginning in the April cycle. And that accounted for a 62 basis point, a one-time adjustment of 62 basis points of the overall decline that you see for the period. The remaining 85 basis points was driven by declines in market volatility and were offset a little bit by an increase in our portfolio factor exposures. We'll examine these in a little more detail in the next slide. Similarly, our benchmark risk also fell during the quarter. It's 11.74% in June, which declined from 12.74% we observed in March. Here again, a portion of that change, 24 basis points, was due to the implementation of the new factor model. Pardon me. The table and chart off to the right show you the differences between your portfolio allocation by assets and your allocation to risk. Similar to last quarter, you'll notice that we've allocated a little more than 2/3 of our assets, 67.29%, to equities. And the standalone risk coming from the equity portion of the portfolio is 17.38%. Standalone risk from our fixed income assets was 4.81%. And on a contributory basis, we see most of that risk, about 91% of it, or 11.64 on a contributory basis, coming from equities. The chart on the right restates some of the same information that you see in the table in the center there. Here, our asset class allocation is the red dots corresponding to the right-hand scale there, and the amounts of contributory risk are the gold bars there, corresponding to the left-hand chart. And again, as before, most of the risk comes from equity. Just plays that out graphically. Looking at the bottom panel, we plotted the one-year trailing portfolio risk, which is the blue line, relative to the benchmark risk, our red line, and the portfolio beta, which are represented by the gray bars there. That's a trailing one-year period for the year ended in June. You notice here that the projected portfolio and benchmark risk continue their downward trends, even after we adjust for that one-time migration to a new factor model. The reduction in risks here, again, were due to diversification benefits or lower correlations and reduced volatility, which were offset a little bit by increases in portfolio exposures to our factor risks. This is the same theme that we've been reporting over the past few quarters, and we have a breakdown actually on the next slide. If you don't mind going ahead, thanks, Diane. Here again, we're decomposing the change in risk from March to June into three broad categories. There's a change in volatility, change in correlations, and the change in portfolio exposure. Those first two categories, a change in volatility and a change in correlations, are market-driven phenomena, meaning that these risks decline in step with market risks and were not the result of specific position weights or tilts in the portfolio. You'll see those corresponding to the blue arrows in the table there. Bringing your attention to that second line, we see that the reduction in market volatility accounted for a 91 basis point reduction in risk. Most of that, 64 basis points, was driven by country factors, which were led by US and Eurozone markets. If we move to the third line, we see that the risk attributed to changing correlations was flat for the quarter. It was a very small positive, I think 0.004, if you will, positive, but effectively flat. This breaks a trend that we observed over the last few quarters where correlations after the pandemic crisis were relaxing a bit, and we saw portfolio diversification increasing and thereby lowering risk overall. The last line, very slightly up, the portion of the portfolio risk that was attached from market trends was up very slightly by 6 basis points. We move on to the next slide. Again, this lines up again with content included in your quarterly packages. Here we're showing the factor risk decomposition. In the table at the top left, we examine our exposures to MSCI's macro factors. Risk here is decomposed among two principal categories, the local market risk and the currency risk. And you can see the components of each broken out among the rows on the table. Looking at the columns, you'll find that the portfolio and active risks broken out in absolute and percentage terms along with their correlations. This is a good reference to show you which factors are contributing the most or perhaps the least to portfolio risk. The table at the top right shows you which of the macro factors contributes the most to active risk or risk relative to the system's policy benchmarks. If we look at the graph at the bottom, we're plotting out our factor exposure among our broad equity fixed income allocations. You see risk is dominated here by the equity factor, which is represented in the light blue shading there. And you'll notice that the equity exposure appears on both our equity and fixed income portfolios. Similarly, we see a bit of fixed income factor exposure in our equity portfolio. That's an important distinction of factor risk versus risk attributed to specific strategies. The factor risk is a common attribute that reveals itself across our various investment strategies. We move on to the fourth slide. Thanks. Finally, here we have some standard shock scenarios that are included as part of the quarterly packages. On your blue box reports, we expose the overall portfolio to a number of shock events chosen from among MSCI's library of default scenarios. As you can see here, they often correspond to market events that occurred throughout history and are meant to give you a sense of how the portfolio and policy benchmark would respond if the same economic conditions were to reoccur. Perhaps not surprisingly, you see the larger predictive drawdowns correspond to the more prominent market dislocations throughout history. And as we discussed last quarter, this view is a fairly prescriptive approach to stressing our portfolios, but it's useful for contextual purposes and offers sort of a jumping off point for building more forward-looking stress scenarios that test more contemporary market trends. That concludes my prepared comments. I'm happy to take any questions you may have now, or my team and I are also available to speak anytime you like offline.
Thank you, Dan. If there are any questions for Dan, please hit the raise hand button in your reactions tab, and you can pose them. But I don't see any. So thank you, Dan.
Thank you.
Okay, Alex, anything else for the quarterly report or public session this morning?
No, John, that concludes our presentations in public session.
Thank you so much. Okay, so with that, we will entertain motions to exit public session and enter executive session at each board. So let's start with teachers. Is there a motion at teachers to exit public and enter executive session?
John, Tom Brown.
Thank you, Mr. Brown. Is there a second?
Second, Susanna Vickers.
Uh,
Sorry, Deb. No worries.
Under the wire there, any discussion? All in favor of the motion at teachers to exit public and executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries at teachers. Next, at NICERS, is there a motion to exit public and enter executive session?
John, I'll move. Martha Sabio.
Thank you, Ms. Camille Sabio. Is there a second?
Second, Robin Roach.
Thank you, Ms. Roach. Any discussion? All in favor of the motion at NICERS to exit public and enter executive session, please say aye.
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 All opposed, please say nay. Any abstentions? Motion carries. At police, is there a motion to exit public?
Motion to exit public session
Thank you.
and enter executive.
Is there a second?
Second, John Dorsa.
Thank you, Mr. Dorsa. Any discussion? All in favor of the motion at police to exit public and enter executive session, please say aye.
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 All opposed, please say nay. Any abstentions? Motion carries. And at fire, is there a motion to exit public and enter executive session?
So moved.
Thank you, Ms. Brown. Is there a second? Who's the second?
Guilfoyle. Guilfoyle.
Okay, Mr. Guilfoyle, thank you. Any discussion? All in favor of the motion at fire to exit public and enter executive session, please say aye.
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 All opposed, please say nay. Any abstentions? Motion carries. Okay, let's turn the cameras off and we will be in executive session. Thank you. Yeah, and is the camera back on? All right, I'm gonna.
Camera is on.
Okay, great. Thank you, Diane. Okay, our first session here is on the draft climate action plan. And presenting that plan is Susanna Vickers and myself. And so who's putting the slides up? Great. Thank you, Nisa. And if you would move to the first slide. And there we go. Perfect. Okay. And then actually move to the second slide. And Susanna, the screen is yours.
Thank you, John, and good afternoon, everybody. I know it's been a long day, and I really appreciate you considering this plan that that John and I are presenting on behalf of the mayor and the controller. We're presenting it as trustees, so this is not a BAM plan, and I just wanted to make that clear on the onset. The plan is designed to put NICERS and teachers on the path to taking prudent, responsible action consistent with our investment beliefs to mitigate the risks, take advantage of opportunities, and reduce contributions our investments make to climate change. It builds upon existing policies and past actions of the board to address the risks and opportunities of climate change consistent with our fiduciary duty and bring NICERS and teachers in line with actions being taken by other leading asset owners and pension funds. John?
Yeah, next slide, please. So as we all know well, the systems have a fiduciary duty to act solely in the best interests of our members and beneficiaries. Our fiduciary duty is grounded in the exclusive benefit rule, whereby we must act for the exclusive benefit of our participants. As fiduciaries, we aim to achieve superior risk-adjusted returns and sustainable long-term performance, since our investment horizon spans decades to meet the system's actuarial liabilities. Our diversification means we have a direct economic interest, even an obligation, to do everything we can to protect against downside and systemic risks and foster stable markets and long-term economic growth essential to the long-term performance of the system's investments. Susanna.
Thanks. Next slide, please. Given this imperative, let's review what we have already done to address climate risk. As this timeline shows, under the leadership of Mike Garland, the controller, and their predecessors, we have been voting our proxies and engaging with portfolio companies to prioritize climate change mitigation and greenhouse gas emission reductions for over a decade. Beginning in 2017, the trustees agreed to join with other major global institutional investors to form the Climate Action 100 Plus to persuade the largest greenhouse gas emitters to take necessary action on climate change. In 2015, we began the process of divesting from thermal coal, and the following year commissioned consultants to conduct an overall climate study and our first carbon footprint analysis of the portfolios. In 2018, we began the process of divesting from fossil fuel reserve owners and increasing our investments in climate change solutions. As you can see, we've already taken a lot of significant steps. Next slide, John.
But clearly, we need to do much more if we are to address the already devastating effects of climate change. If we take no action on climate change, the global economy could suffer ruinous losses at great cost to the system's portfolios. Next slide, please. This chart illustrates potential economic losses from different climate change scenarios. You see in the upper right-hand corner the potential reductions in global GDP in a business as usual scenario with a temperature increase in excess of 3 degrees Celsius by 2050. Even if we achieve the Paris target of well below 2 degrees Celsius, we suffer some economic losses, but much lower than if we do nothing. These climate change related risks are systemic. We cannot diversify them away, and severe, as clearly they can lead to the failure of broad segments of the market and economy. Unfortunately, some negative impacts are already irreversible, and many will rapidly worsen without immediate and ambitious global action. Next slide, Susanna.
Thanks, John. This slide from the World Wildlife Federation illustrates just some of the increasingly devastating effects that arise if the globe warms by 2 degrees instead of the 1.5 degree scenario by the end of the century. These impacts include, but are not limited to extreme heat waves, intense droughts, rising sea levels, increased flooding, reduced food production, melting polar ice, and the loss of habitat in many endangered species. Next slide, please. So what is net zero? The 2015 Paris Agreement, signed by nearly all nations of the world, established the goal to limit global temperature increase to well below 2 degrees compared to pre-industrial levels, and to make efforts towards a limit of 1.5 degree. The Intergovernmental Panel on Climate Change, IPCC, found that accomplishing this limit requires reducing carbon emissions by 45% by 2030 compared to 2010 levels, and ensuring carbon emissions are net zero by 2050, along with deep reductions of non-CO2 emissions such as methane. The IPCC defines net zero emissions as the point when anthropomorphic or caused by human emissions of greenhouse gases to the atmosphere are balanced by human removals over a specific period. While 2050 is the ultimate deadline for achieving net zero emissions, meeting that timeline in no way provides a guarantee of 1.5. So I want to repeat that. If we try to manage to the deadline of 2050 because of the climate change that's already occurring. Meeting that timeline does not guarantee that we'll be, that as the world, all the people in the world and the earth will be able to guarantee the warming of below 2 degrees or at the 1.5 threshold that's preferable. The IPCC found that reaching net zero 10 years earlier by 2040 would substantially improve the probability of limiting warming to the 1.5 degree threshold. Specifically, reaching net zero emissions by 2050 gives us only around a 50% chance of limiting temperature increase to 1.5. However, getting to net zero by 2040 considerably increases this probability to around 67%. The latest IPCC report released in August 2021 further found that negative climate change impacts are worsening in and affecting every region of the world. And we know that includes New York City from the twin storms of Henry and Ida we had a few weeks ago that each set new rainfall records. The IPCC stated that unless there are immediate, rapid, and large-scale reductions in greenhouse gas emissions, limiting warming to close to 1.5 or even 2 degrees will be beyond reach. Furthermore, the International Energy Agency has stated that while the number of countries that have pledged to achieve net zero emissions has grown rapidly over the last year and now covers around 70% of global emissions of carbon, it is still not nearly enough to achieve net zero or 1.5. Therefore, we need more ambitious action sooner rather than later to limit warming to 1.5. And we propose that we set a goal of net zero by 2040. Next slide, John.
Climate change represents not just a threat, but a large and growing set of investment opportunities as well. The International Energy Agency estimates that to achieve net zero by 2050, clean energy investments need to triple by 2030 to over $4 trillion each year, resulting in well over $100 trillion over the next 30 years. In addition to clean energy, climate change solutions also include economic activities that contribute substantially to mitigation, adaptation, and/or resilience in relation to climate change impacts such as energy efficiency, sustainable water, and pollution prevention. So we are proposing that the systems adopt prudent goals to increase investments in climate change solutions across the investment portfolios, consistent with fiduciary duty, in order to achieve competitive market rate risk-adjusted returns appropriate for each asset class. We specifically propose that the system set an initial goal of doubling investments in climate change solutions across our portfolios to approximately $4 billion each at NYSERS and teachers by 2025. You can see that as the bottom bullet. And seek to achieve a total of $17 billion at NYSERS and $19 billion at teachers by 2035, consistent with fiduciary duty and our investment objectives. Now, these represent proposed goals from the mayor and controller as trustees at this time, and not from BAM, which hasn't weighed in one way or the other. The boards would periodically assess and update climate solutions investment goals in consultation with our investment advisors, taking into account each system's asset allocation, pipeline, and opportunity sets for each asset class. Next slide. So this is a chart from my office that shows a rough trajectory of how we can achieve these investment targets. This is using NYSERS as an example, but the numbers are similar for teachers. So the blue bars, starting with 2.475 billion in 2021, those blue bars show the total amount of investments in climate solutions now and in 5-year increments. The green bars show the total amount of new investment necessary during each period in order to achieve these goals. So from this year until 2025, we would need a total of 750 million, or about 187 average per year, with the rest to get to the 4 billion coming from investment returns. So the average investment increases to about 415 million per year from 2026 to 2030, and to 1.1 billion per year from 2031 to 2035, in order to arrive at the $17 billion goal. So you can see that it slopes upwards, and that is because we anticipate that the opportunity set for investing in climate solutions will increase dramatically over the next 15 years as we transition to a low carbon and net zero economy. Next slide, Susanna.
Thanks. The 2015 Paris Agreement acknowledged the need to account for the imperatives of a just transition of the workforce and the creation of decent work and quality jobs. The system's investment beliefs state that we favor strong human capital practices characterized by standards of good conduct, including fair labor practices, health and safety, responsible contracting, and diversity. This underscores our commitment, consistent with our fiduciary duty, to ensure that our investments support a just transition from carbon-based to a low carbon and net zero economy. This depends on genuine stakeholder engagement with local communities, workers, and their union representatives. We will make efforts as investors to ensure that energy transition does not result in the lowering of overall compensation levels, replacement of local with a non-local workforce, or reductions in maintenance, staffing, or workforce skill levels that have the potential to compromise worker, public, or environmental safety. Our responsible contractor policy expresses support for fair wages and benefits, workforce training, and safety and health, and a position of neutrality with regard to union organizing, which we believe deliver higher quality products and services. So support of a just transition in climate-related investments flows directly from our existing policies. Next slide, John.
So as Susanna said earlier, we are proposing that teachers and NYSERS commit to the goal of achieving net zero greenhouse gas emissions by 2040 across our investment portfolios to mitigate the systemic risks of climate change to our investments and the real economy, while taking into account the best available scientific knowledge and fulfilling fiduciary duty. To support our efforts to prudently achieve this goal, we propose that both boards adopt and join the Net Zero Asset Owner Commitment of the Paris-Aligned Investment Initiative, a formal partner of the UN Framework Convention on Climate Change's Race to Zero campaign. It's a mouthful, which would allow us to collaborate with and learn from other large asset owners and leading practitioners. I think in convene you have a summary of this commitment, and you can think of it as similar to our commitment to the principles of responsible investment, which both boards have also committed to. However, there is no cost to us for making this commitment. We propose that the implementation plan for this climate plan also include, but not be limited to, the rest of the elements on this page. That we adopt prudent interim targets for reducing greenhouse gas emissions at portfolio and asset class levels, beginning with a target for 2030 or earlier, and an updated interim target for every 5 years thereafter. That we make prudent consideration of climate change risk and opportunity and net zero alignment in the evaluation, due diligence, selection, and monitoring of asset managers in all asset classes to be a key factor in investment due diligence. that we conduct carbon footprint analyses of our public equity and corporate credit portfolios, measuring scopes 1, 2, and 3 emissions annually, expanding to other asset classes depending on adequate data and methodologies, and that we continue our principles in proxy voting and engagement with portfolio companies to prioritize climate change mitigation and greenhouse gas emission reductions, energy efficiency and conservation, use of cost-effective renewable energy, and other measures to enhance shareholder value consistent with 1.5 degree pathways. Susanna?
Thank you. Next slide.
Oh, that's it. That's the last
Oh,
slide.
that's it. We don't have a wrap-up slide. All right, we're done.
Thank God.
I know, it was a mouthful. It's a lot.
That was a lot to take after this, what we went through this morning.
It's a lot. And, you know, what we propose now is to open it up for discussion here or in the caucuses. And I just want to underscore that, you know, the plan envisions that, you know, if trustees wish to adopt this, the next step would be to direct our investment advisors, which could include BAM and our investment consultants, to you know, develop the details around implementation of this plan within the general parameters we have described for your review.
Susanna, did I hear in the last half hour that the consultants weren't apprised of this?
Correct. So this
No,
is
they have been apprised of it. Yeah.
okay. They're not what
not
John
part
and
of
I were
this?
trying. Tom, what John and I were trying to make clear is that this is a proposal that hasn't been reviewed and poked and prodded and put through all of the, you know, the investment mechanisms that that BAM or in your case, Rogaton or Callan would normally do when looking at a new investment recommendation shift like this. So this is really a desire for goal setting laid out by the mayor and the controller. And, you know, the plan has been circulated to BAM and the investment consultants. It's on convene, but they haven't weighed in terms of establishing goals. The general parameters that we're suggesting are consistent with the goals and parameters that are being adopted by other institutional investors worldwide.
Okay, can we have this discussion possibly at a different time? Lay it over to discuss? I know Debbie and I have to be in Albany at 5:30 today for
Oh, gosh.
meetings.
Yeah, sure. We just, this is our initial presentation, that's all. There's no action item to discuss or to vote on this today.
Yeah, okay, I'm game to just lay it over and discuss it at a different time.
I just want to say, Tom and other trustees, that I think Susanna mentioned that at the COP 26.
I was going to.
Oh, I'm sorry. Go ahead. Let me not steal your thunder.
Okay. So we were hoping that, you know, that we're not going to take action today, but that we could discuss and hopefully take action over the coming weeks.
And what is your time frame for getting this said? What time frame? What's your goal?
Well, maybe we can have a discussion before the next sim.
But let me just say, so at COP 26, which is taking place in Scotland in November, which is the follow-up, you know, the follow-up conference to the 2015 conference in Paris, where the global climate agreement was agreed to. There's going to be an announcement of global investors that have made net zero commitments. And if we want to be part of that, which obviously we are not required to be part of it, but if we want to be part of it, we need to make a decision by the next sim. by October 20th, which is the date of the next SIM. So we can the trustees can decide, whether they want to do that, whether they want to tweak this plan or adopt it as is. It's obviously totally up to the trustees. What we do is, Susanna said, this proposal from 2 of the trustees on both of these boards. And, personally, I hope that
And John, I'm sorry, when we adopt it, what does that mean? We vote on it at a board and we all have consensus, or we approve it, or what does that mean?
vote on a resolution as we do on any other.
Well, I'm up. I don't know about the other trustees. I'm up for a conversation. I mean, you made very good points.
That's what we're expecting, is just a conversation going forward
But
over the
we
next
don't ever
month.
do anything so quickly. I mean, by the next sim, all this, I mean, we need a conversation, we need a discussion, we need to vote on it, we need consensus in a month. Weird. I wonder why. Okay. It's a lot, but I'm up for the conversation.
Okay, so let's definitely have a conversation. There's no deadline. We're just expressing a potential pathway, just in terms of what the next dates coming up are.
Okay, and if it's not done by the next SIM, I mean, then it could still be done. It seems like it's a lot to discuss and to make a decision with such a
Correct.
lengthy agenda. Good.
Correct. And I think just, sort of bottom lining it, we wanted to present, this idea in a very fulsome way with a lot of detail about, sort of the rationale and, sort of the best practice thinking around decarbonization and net zero, and sort of what's happening by other institutional investors. But when you strip all of that away, the request is pretty simple in terms of suggesting that the boards establish a goal for net zero.
I wish everything could be this simple.
I hear some feedback. I don't know if that's me or someone else, but I just want to say yes, it seems like a lot, and we'll discuss this going forward. But when you strip, kind of the detail away, what we're asking for and what we're suggesting is pretty direct.
Other comments for this session today? And again, yes, Larry.
Yeah, John, if my understanding is correct, and correct me if I'm wrong, is you're not binding future boards from making prudent investments that don't necessarily get us to where we're trying to get to, depending on what market forces and occur. This is just aspirational, is that correct?
I would say that's right. We're setting goals, right?
Okay.
We're setting goals, and the 2 main goals that we're setting, if we adopt this, are A, to get to net zero by 2040, and B, to set goals for investments in climate solutions. These are proposals that the controller and the mayor are making, and but they are just that, they're proposals. And so our hope is that the boards will adopt these proposals, but we don't, and again, like a goal is just that, it's a goal.
Right.
Just to reference it, in 2018, trustees set a goal of achieving fossil fuel divestment within 5 years. That was a goal. It wasn't, and we had to conduct a study, as everyone knows. It was a long process to determine whether we were going to be able to do that or not. And it's sort of the same thing. We're proposing that we set a goal, and hopefully we can achieve these goals, and future boards can do it. But as we said in the presentation, we would expect that the boards would reassess these goals on a regular basis. And, you know, I think a lot depends on what happens in the global economy.
Right.
You know, I don't think anybody can sit here today and say, we know that, you know, this amount of climate solutions is achievable by 2035. We hope that it is, and we want to help lead the effort to get there. And same thing with the net zero commitment. You know, you couldn't be net zero today. It wouldn't be possible in the current global economy and with the current technology. But it is our hope and expectation that with leadership from the New York City retirement systems, we can help get the economy to be net
Moving in that
zero
direction.
by 2040, and then help and also profit from that as investors to the benefit of our participants and beneficiaries.
Understood. Thank you.
Anybody else want to weigh in at this point? Okay, great. So thank you. I want to also just recognize Jimmy Yan from the Controller's Office, who is a major contributor to putting this all together. And so that, I believe, concludes our joint public session for today.
And can I just add, thanking Misa Burkham for putting up with me, John, and Jimmy in the development of the slides and the scripts. I think she deserves extra credit for that.
Okay. All right. So now we're going to entertain motions to go back into executive session. So let me start at NYSERS. Is there a motion at NYSERS to exit public session and re-enter executive session?
So moved. This is Tanya Cantlow.
Thank you, Ms. Cantlow. Is there a second?
Second.
Thank you, Mr. Jetter. Any discussion? All in favor of the motion at NYSERS to exit public and enter executive session, please say aye.
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 All opposed, please say nay. Any abstentions? Motion carries. And the teachers, is there a motion to exit public session and go back into executive session?
So moved.
Okay, Mr. Brown, Ms. Penny, was that a second?
Yes, please.
Thank you. Any discussion? All in favor of the motion at teachers to exit public session and re-enter executive session, please say aye.
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 All opposed, please say nay. Any abstentions? Okay, motion carries. So we are now going back into executive session. Can we turn the cameras off, please?